Friends, this is CA MK classes and I am MK Core and having at least 28 years of experience in teaching at different places and different institutes. I like to bring before you one of the most important chapter of management accounting, that is leverage. The word leverage has got certain scientific and financial advantage. The leverage means certain advantage, and this advantage is measured with the help of ratio. So what is that advantage? We generally input certain fixed cost. The company incur fixed cost, and the expectation is how the input is resulted in the output, that is revenue. How the cost will magnify the revenue, how the input cost will increase the revenue. So the effect of the fixed cost on the earnings of the firm is measured by the help of leverage. Let me give you an example. Suppose this is a cycle, this is front wheel, जहाँ chain है, and the chain is connected to the back wheel also. This periphery of this particular shaft is 30 centimeter and the periphery of the back wheel is 10 centimeter. The person riding the cycle is putting the weight here, pedaling. He is pedaling here and he is trying to move this bigger shaft, and if this moves the 30 cm, and this will result in movement of 3 times. So one time movement of this result in 3 times movement of the back wheel. So if the back wheel moves 3 times, that means you are getting certain advantage of moving this one. So this is our input. Maybe this is a fixed cost, this is input, because here we are applying the force, we are pedaling, we are applying the mechanical force, and the output is 3 times. So moving this one once, this will move 3 times. So this is a advantage, because we are inputting force here, we are inputting cost here, and we are getting the revenue 3 times. Think of, in management accounting, this is your earnings and this is your input of fixed cost. So if you apply your fixed cost, how many times your earnings are increasing, that is your leverage, right? As that is your leverage. So let us come to, so this is an example of the leverage. Then we will come to how this leverage actually works. Friends, I want to make a complete class on this chapter. So whatever I am giving you as a teaching, you will get at the end of the video all the slides, and you can note it down, the theory notes, the problem, the solutions, everything you can download at the end of the video, so that we will also cover lot of problems, so that you won't find any difficulty in the exam. So let us continue with the next part. The next part is, so leverage is an advantage. If I apply certain fixed cost, how the earnings is changing. Suppose I am paying salary, rent, other fixed cost, how it is affecting my earnings. That is your leverage. And we know that sales, this is less the variable cost, then comes the contribution. This you have read in your marginal costing. Then less fixed cost. This is operating fixed cost. This is operating fixed cost. That means it does not include your interest. Then it comes to your EBIT, right? Less interest. It comes to your EBT. Then less tax. It comes to your EAT. So friends, if we analyze this concept, sales minus variable cost, contribution, fixed cost, EBIT, interest, EBT. So this is a particular format, you might be knowing this. Now we are seeing this is contribution, this is fixed cost. If fixed cost is high, then definitely EBIT will come down. If fixed cost is low, then EBIT will be more. Suppose this contribution is 100, fixed cost is 25, and EBIT will be 75. This is a very good situation, because EBIT is quite high in comparison to the fixed cost. So if we take, it is 100, it is 75, this is fixed cost is high, we are seeing this is only 25, this is a very risky area, because my fixed cost is quite high. Therefore my earnings before interest and tax is quite less. Similarly, if we make a interest less here, we will get a EBT, earnings before tax. So these two fixed cost is here. One is your operating fixed cost, and one is your operating fixed cost, another one is your interest. In the leverage, we will analyze the risk of the fixed cost, the risk of the interest with the earnings. So The leverage actually measure the business risk, and the business risk here are of many times, but in the chapter leverage we take into account the basically two risks, that is, one is your operating leverage, operating risk, another one is your interest risk, that is financial leverage. So when we are taking, this is a less risk, this is high risk. This is high risk because your EBIT is quite less in comparison to your contribution. Here EBIT is quite high, so this is a healthy position. So depending on the operating fixed cost, we have got operating risk, that is degree of operating leverage. Depending on interest, we have got financial leverage. So friends, let me come to the different types of leverage. Here the leverage is of two types. One is your operating leverage, and this operating leverage concept comes from the fixed operating cost. So operating leverage, it is shortly called as degree of operating leverage. Another one, fixed cost, is your interest. This is called financial leverage. This is your financial leverage, and this financial leverage is called degree of financial leverage. This degree of operating leverage actually measures the effectiveness of your fixed operating cost on the earnings. This degree of financial leverage measures the effectiveness of interest loan on the earnings of the company. So DO and others, in some cases we take two leverage, that is operating leverage and financial leverage clubbed together, we take into account, this is called DCL, or degree of combined leverage. The operating risk and the financial risk both are risk area, and if a company has got both the things, then we can measure what is the total risk of the company. And this DCL, the risk factor here and the risk factor is also here. And in a company, if there is a loan, there is a interest, then definitely DFL can be calculated. Fixed, if definitely there will be some fixed cost, so DOL can be calculated. We can find out the impact of both the risk by the application of DCL, degree of combined leverage. This degree of combined leverage is a product of DOL into DFL. DOL into DFL. Right? So with this fundamental, let us come to the details of operating leverage and details of financial leverage. So operating leverage. At the end of the class, you can see all the notes like definition of your operating leverage, formula. I am writing the formula here. I have already told you whatever I am telling you, all the notes you can get at the end. So degree of operating leverage, it has got measurement in two ways. One is your, that is DOL is equal to contribution by EBIT, right? All of we know contribution minus fixed operating cost, this will give you EBIT, and this EBIT and contribution are related with the fixed cost, right? So this ratio, contribution by EBIT, will tell you the degree of operating leverage, right? Suppose contribution is 100 and fixed cost is 25, then this is 75. So degree of operating leverage will be 100 by 75. This is an example. 100 by 75, it comes to, this is 1.33. The another formula is percentage change in DOL, percentage change in EBIT divided by percentage change in sales. Percentage change in sales. Generally, for your problem, this formula is more oftenly used, and this formula is used also, and we shall apply this formula on doing the problem. So friends, these are the two formulae you have, and we shall, on doing the problem, we shall apply the formula. So please keep it. Then comes the financial leverage. Financial leverage. Suppose a company has taken 1 lakh loan at 12%. That means it is paying 12,000 interest. So by using this loan, how much the company is able to generate revenue? This measure is your financial leverage. So financial leverage is defined as ability of the firm to use the fixed financial charge to magnify the effect of change in EBIT. This definition you can see at the end in my notes. So financial leverage, this is also, it has got also two formula. There are two ways of measuring. One is your degree of financial leverage. EBIT divided by EBT. Another one is your percentage change in EPS, degree of financial leverage, percentage change in EPS by percentage change in EBT. So friends, if you see EBIT less interest, this is your EBT. If you take EBIT as 100, interest is only 10, it is 90. So the ratio is 100 divided by 90, it is 1.1. And the risk is too low. Suppose this is 100 and the interest is 60. So EBT is 40. It is a high debt company. It is a low debt company. So in this case, 100 by 40, it comes to 2.5. So if it is 2.5, then it is more risky with the loan, right? Here the risk is less. Here the risk is more. Here EBT is quite high. Here EBT is quite less due to presence of high interest. So this is your financial leverage. Then comes the combined leverage. Combined leverage. This combined leverage is nothing, DCL equal to DOL into DFL. Now we have got also here there are two formulae. One is your DCL is equal to contribution by EBT. If you take into account DCL is equal to DOL into DFL. If you take DOL, this is contribution by EBIT into DFL, EBIT divided by EBT. So if we cancel this, automatically we are coming to this particular formula. Okay, so this is one formula, and another one is your through EPS. Percentage change in EPS by percentage change in EPS by percentage change in sales, right? So with this formula we can calculate the combined leverage. This formula have got a lot of significance on your doing the problem. So combined leverage actually measures the total risk of the firm. Here we are seeing DOL, degree of operating leverage, degree of financial leverage, combining both, we are getting degree of combined leverage. There is no hard and fast standard. However, in some cases, we consider certain standard for taking a decision on the risk profile of the business. So let us come DOL, less than or equal to 2, moderate risk. Moderate risk. If DOL is greater than 2, high risk. High risk. Similarly, DFL less than or equal to 2, moderate. Greater than 2, high risk. DCL less than or equal to 3, moderate. Greater than 3, high risk. And this standard, of course no standard is specified, but still we generally use this one for expression of decision. Suppose the degree of operating leverage is 3, that means there is a high risk with the fixed cost. If the DFL is say 3, that means there is a high risk of interest. And if the DCL is greater than 3, we can tell both the risk of the firm is quite high. So this leverage concept is used as a warning for the sick company, prospective sick company. Those company, it can be used as a red flag for the company's performance. Right? Friends, now you can see the question and we are going to start with the problem number 1. Right? You have seen the question, and in doing the problem number 1, we need to revise the PV ratio. All of you know from the marginal costing concept that is PV ratio is the contribution by sales into 100. This PV ratio is used for sales contribution by sale into 100, it is expressed in percentage. Another one is your net profit ratio. This is very simple, all of you know. This is net profit divided by sales into 100. This is your net profit ratio. And another one, as you know, the net profit ratio, PV ratio, and sometimes we also use the break even. Break even sales. The break even sales is that sale where there is no profit, no loss. Break even sales is the level of production and sale where the company does not earn profit, does not earn loss, neither profit nor loss. This is your break even sales. And this is formula is fixed cost divided by PV ratio. This is your break-even sales in rupees or amount. So these three formulae are also sometimes used in doing the problem. All these formula, this 1 and 3, both you have seen in the marginal costing, and net profit ratio you have seen everywhere for doing the problem. So let us start with the problem. You have read the problem. This is two farms, Karan and Arjun. They have got same profit and you are required to compute the operating risk of the farm. The operating risk of the farm can be computed with operating leverage, degree of operating leverage, PV ratio, net profit ratio, break-even sales. So let us start with the problem. This is your particulars. This is particulars. This is farm Karan. This is farm Arjun. Right? So if we take here, the first one is your PV ratio. This is a measure of operating risk of the firm or operating ability of the firm. As the PV ratio, contribution by sales, if the PV ratio is higher, the ability of the firm to generate income is definitely higher. So PV ratio is contribution by sales into 100. Contribution by sales into 100. In case of Karan, contribution is 80,000, sale is 2 lakhs into 100, it comes to 40%. In case of Arjun, it is 1 lakh, the contribution is 1 lakh, sales is 2 lakhs, it comes to 50%. So this is your PV ratio. Then we are coming to net profit ratio. Net profit ratio. Net profit ratio, this is net profit divided by sales into 100. The net profit as given in the problem is 50,000. In both the firms, the net profit is same, 50,000 by 2 lakhs into 100. This is 25%. Here also 50,000 divided by 2 lakhs into 100. This is also 25%. Now that is break-even sales. Break-even sales is your fixed cost divided by PV ratio. So if we take the fixed cost here, in case of the first one, Karan, the fixed cost is 30,000. So 30,000 is the fixed cost, and 30% is your PV ratio. PV ratio is 40%. So 30,000 by 40% is equal to 75,000. Here also it is 50,000 by 50%, it comes to 1 lakh. So far as the break-even is concerned, Karan has a lower break-even than the Arjun. Karan's break-even is 75,000 and Arjun 1 lakh. That means if Karan's sale is 75,000, there is no profit, no loss. Below 75,000 there is a loss, and above 75,000 there will be profit. Similarly, here in case of Arjun, in 1 lakh there is no profit, no loss. If the sales is below 1 lakh, there is a loss. If the sales is above 1 lakh, there is a profit. So let us come to the last one, that is your degree of operating leverage. Next, coming to degree of operating leverage. This is your contribution by EBIT. Contribution by EBIT. Contribution is 80,000 and EBIT is 50,000. Here the profit is EBIT because there is no interest. So contribution by EBIT, it comes to 1.6 in case of Karan. In case of Arjun, it is 1 lakh divided by 50,000. This is equal to 2. So friends, if you look at this degree of operating leverage 1.6, below 2 the risk is moderate or lower. In case of Arjun, the operating risk is 2, and there is a chance that it may be greater than 2 in the future. So operating risk of Arjun is higher and operating risk of Karan is lower, right? Here you see the PV ratio is 40, PV ratio is 50. It is a good sign. Net profit ratio is same, break even. It has a lower break even, it is a higher break even. But so far as the degree of operating leverage is concerned or operating leverage is concerned, Arjun has a high risk than the Karan. So this you have to write in the comment section. So friends, we will be coming out with more problems on the second class or second session, and if you like, you subscribe and offer your comments. We will be providing the important problems, all the important problems will be discussed in the class itself. So, thank you, meet you again.